Please remember that nothing we say here should be taken as personal advice. The conversation is for entertainment purposes only. If you have questions about your financial situation, please talk to a licensed financial advisor. All right, welcome to another episode of Future Money, where we talk about the investments of the future
that will make us money.
Us money. And speaking of making us money,
yes,
today's podcast is dedicated to the new bull market.
I am feeling cheerful myself. It's been a nice little run, nice year so far.
Yeah, I mean, it's definitely better than some of the podcasts we had last year, which was don't look at your accounts, what's a recession.
We've had a lot of negative podcasts last year, so I think it's nice. It's nice really to kind of talk through what's positive, have a little bit of optimism going into the end of the year, right?
Yeah, for sure.
I frankly did not think this year would be this good.
No, I don't. I think there were very, very few people around that thought that we'd be here now.
Yeah, right. It's just, it's markets are just tough to predict. It's just impossible to predict, and this year, despite all the negativity, we're having a really fantastic year.
Yeah. Now we're starting to get positive, which is, that's always when we're like, okay, let's at least look at things. But it has been great historically. Bear markets are shorter than bull markets are.
Yeah.
So
let's start there. Let's start there. I like that. Let's start with what's a bear and what's a bull market. I think people throw these words out there like that. Like let's define them. Yeah,
I mean, so really simply, they're the same, just opposites of each other. A bear market is defined as 20% decline from a certain point. And a bull market is the exact opposite, is a 20% upside from a certain point. So, normally speaking, when markets hit these sort of markers, in a bear market, there's generally more downside when that happens. In a bull market, there's generally more upside from there. People kind of use these numbers, and it's funny, like our brains as humans are sort of earmarked and tagged with these, like they're anchored to these certain numbers, 10%, 20%.
Right.
They're really ultimately meaningless in the world of math, but because we think they're a thing, they are a thing, right? It's a self-fulfilling prophecy.
I think you just call it's an anchoring thing. It's an easier way to really make sense of the world, right?
Sure. But because everybody thinks that's the thing, right? It becomes a thing, right? 100%. So everybody who's investing and trading is like, oh, well, there's a bear market. Yeah. So, we hit 20%.
Well, I think the theory is a little bit more, can be even broadened up, right? Bear market basically says that the tendency is for things to keep going negatively, right? There is a lot more pessimism about where things are going. Usually it's there is earnings are going down, maybe unemployment is going up. There's a lot of other indicators that can follow a bear market, right? The last bear market that we were in, I think we entered that sometime in May or June of last year of 2021, right?
Yeah, I thought maybe March even.
Maybe March, right.
So, March of last year. And then
so that lasted for 14, 15 months roughly, right?
Yeah.
We just got out of it in May of this year. But, that's kind of these are tendencies or these things that you can look at over the long term, right? Bear markets will last from a year to 2 years on average, right? And bull market will last for how long usually?
Yeah, so I like to use median versus average because there's not a lot of huge bear markets. It's funny because we talk about these things, but bear markets happen, but over the course of history, there's only a few dozen bear markets. So it's not a big number. Median I like to use because it doesn't get skewed by the huge sort of big ones. So on the median lasts for about a year for bear markets, and for bull markets, it lasts about 5 years.
Right.
So if history is any kind of indication, hopefully, we're in for a longer trend upswing from here.
Yep.
Obviously, those numbers can be anywhere. They're skewed in any one direction. Yep. The shortest bull market was something like was like
3 months.
Yeah, it was like 98 days or something.
Yeah. That's when COVID happened, correct?
Yeah.
Okay.
Yeah. And that happened fast and furious. And it didn't make it any easier because it was so fast.
Yeah, we were stuck at home.
You know, but you know, and also the bear market during COVID was really fast, right? Like really quick, you know, quick back up. So obviously, you know, COVID was kind of this weird outlier that we sort of almost have to strip out from all these numbers because it was such a weird time.
Well, also the government kind of came in and really printed a ton of money, which really kind of helped change the whole rhetoric, right? So,
you know, obviously the arguments that it created inflation and all that kind of stuff, the free money is true. But if you think about kind of what was going on, right, we always try to learn lessons from history. And, you know, when money supply dries up, when people are doing nothing, somebody has to step in, right? Unlike when the Great Depression happened, when people had no idea what was coming.
Well, listen, this is why the outsize kind of Fed really impact on the economy and the markets in general, right? Yeah. When you print that much money, people have to use that to buy assets, you know, stocks, real estate, all that benefited tremendously from what happened, right?
And we didn't know. Remember, you know, in March of 2020 when the Fed did this, we had no idea how long COVID was going to go on.
Hindsight is beautiful, though.
Yeah, exactly. We had no idea. Like it could have gotten way worse, you know, depending on how the disease went. But it ended up working out, obviously, and now we're stuck with the Fed on the other side, raising rates all the time.
Sure.
And, obviously, and today, actually,
we're recording this on hopefully the last time the Fed raises rates, right?
That's the hope.
I think the headline on Bloomberg this morning was it's the highest rate in the Fed in 22 years, right? Yeah. So this is, you know, we're talking 525 basis points, 5.25% in the last, you know, 15, 16 months. That's a lot.
Yeah,
you know,
for sure. But I'm gonna, you know, let's be controversial here, you know. The Fed has kind of done a good job, I gotta say. I was very critical of their many rate hikes.
Ayal hasn't talked to anybody in real estate the last couple of weeks.
Listen, you know, which part of real estate, you know?
I had breakfast with a bunch of people who work in commercial real estate last week.
Well, yeah.
That was not fun.
Hopefully it's not office space.
Yeah, it was actually office space in downtown LA.
You know, that's honestly, that's not really the Fed's fault. That's a secular shift in the way our economy works now. Yeah. But yes, obviously it affects things. Obviously there's things that broke, i.e. Silicon Valley Bank and First Republic. Today, we hear that PacWest is being acquired. Yeah. So there's definitely things that happen. However, you know, the economy, to the Fed's credit, again, I have no interest in the Fed here, right? To the Fed's credit, the economy has been much more resilient than anyone gave it credit for. And, you know, when they started this...
the Fed gave it credit, I think.
That's what I'm saying. When the Fed started this really aggressive rate hike campaign, I think they did it. They were more aggressive than they needed to be because there was so much free money and the economy was doing very well. And so, like, their thought process was, if we're going to do it at any time, this is the time that it can handle it.
Yep. And your economy has proved to be quite resilient. Yeah. Right? Like, it's, I mean... We're seeing unemployment still fairly low, right? For any kind of slowdown, we haven't seen a true recession. So let's bring it back to like what's so we know what a technical definition of a bull and a bear, right? I get this question a lot from clients, like, why is the market up? Like, everyone I talk to, it feels anxious. Fed is raising rates. You know, there's a lot of negativity. You know? Let's talk about that because I think that's really important from our perspective, right?
Yeah, I think if you've been investing as long as we have, you understand a concept called, you know, number one, don't try to time the markets, right? Because you're just never going to get it right. But the stock market has this tendency to do what we call is climb the wall of worry. Yep. That there's always something out there. There's always some stuff that looks negative.
There's always a Russia. There's always a recession. There's always
there's something looming on the horizon all the time. And I think the important thing is to understand is that, you know, you're not going to get it right. Right. So just don't try. Right. So sometimes you get a little bit more aggressive. Sometimes you get a little bit more conservative. But ultimately, the stock market tries to guess where we are, right? Yeah. And if things are not great, but less bad than people expected.
Yeah. And I think
That's
also,
a good thing.
but also like the stock market is like almost a discounting mechanism.
Yeah.
Like it looks at everything and it discounts it, right? So everything that we talked about, recession, earnings recession, Russia, all the negative stuff that's happening, it's been kind of almost priced in. And the market is looking for the next 6 to 9 months. What are things going to be? And obviously what it's telling us today is that things are going to be a lot better than they are today.
Yeah, things are not going to be so bad. I mean, things are pretty good right now. I mean, I don't know if like, obviously there's been layoffs in sectors and things like that, and we have clients in tech who have been laid off, and
unless you're in Hollywood.
Unless you're in Hollywood, well, the Hollywood strike is once again not a function of the Fed or anything anybody could say, but right now things are not as bad as people thought they would be. Things are actually pretty good. If you look at travel numbers, you look at restaurant numbers, you look at, the unemployment rate.
I looked at the American Express's numbers last week. You know, they're fairly strong. You know, it's usually by travel, people experiences, restaurants, and so forth. There is just money around the economy. That's
and you can argue, okay, well, that we printed a bunch of money and gave it to people. That's true.
Yep.
But regardless, like, now inflation has become very tame, right? I
think that's the biggest point, right?
Yeah.
Inflation is coming down.
Yeah.
The difference of this year is when we started the year in January, right?
Mm-hmm.
Base case was we're going to have a massive recession. Inflation is going to be out of control. Now we're July and we're not going to have a massive recession, and inflation is coming down drastically.
Yeah.
Right? That's a big win for everyone, and this is why people are more optimistic about the future.
Yeah, look, there was so many like boogeymen last year. It was kind of all together, right? You had the Fed, you had inflation, you had Russia, you had the midterm elections, right? You had China locked down again, right? Yeah. And all these things have sort of reversed course. With the unfortunate part of the Ukraine war is still going on.
Yep.
But the energy price shock that we had from that, right? That was part of the inflationary problem last year. Also, all of those have abated, and so everybody's feeling a little bit better, feeling more optimistic. And not to mention, this is my own personal opinion. The secular bull markets, as we call them, markets that kind of have a multi-year bull run, generally have some kind of catalyst behind them.
Yep.
And I think this one, is to use your favorite thing here, Hatem, is AI.
Right.
AI is now generating this idea, much like cloud did, much like social media, mobile, internet. Like there's this trend now that technology is gonna level up.
Yeah. Even more bigger than that, I think I would say innovation is what's driven the U.S. economy for so many years.
Sure.
Right. If you look at, like, I went to college for international business economics, right, and finance. But if you look at longer trends, and we learned about this in college and all the time, is that innovation is what drives these long cycles.
Absolutely.
But America was the only country that's able to really have so many different industrial revolutions almost, since really, the early 1900s.
1800s.
Right? 1800s, right? So, and this is happening again with AI right now, right?
For sure. Well, I think they're calling this the fourth industrial revolution.
Yep.
Right. So I do think that, I think on the short term, markets are very optimistic, right? But over the long term, over the next several years, there's all kinds of numbers being thrown out. AI is going to add $7 trillion to the, like, who knows, honestly, right? But ultimately, this is the next wave of innovation, as you're talking about, and we don't even know what's coming. That's the thing, right? Like when the iPhone launched, or when when Netflix launched, like we had no idea what was coming after that.
Sure.
Right? It was just kind of this new process, and we're just getting started.
Yeah, and the internet, like I think the bubble of the 2000 that was driven by this excitement around the internet.
Yeah.
But 99% of those companies are no longer existing today. It's different. This AI thing is different because a lot of these companies are actually big players, from Microsoft to Google to Nvidia to all these things, are actually real businesses with real revenues, and they're actually providing some true productivity gains to other businesses who are making even more money, right? So you're seeing the bottom line impact on almost today. Right.
Well, so some companies are seeing the bottom line impact, but some companies are actually Microsoft and Google just reported yesterday.
Yep.
As much as I love those companies, they're all richly valued now, but they're also saying things like they are going to have to invest for AI. Like, that's a good thing, obviously, over the long term, but on the short term, it might hit their bottom line.
ChatGPT is super cool, but it's really expensive to run those queries.
It's really expensive, and ultimately, like, is it generating them extra revenue right now? Probably not.
No.
Right? So that's something that both kind of Microsoft and Google kind of touched on in their earnings is, we're yet to see a net positive from AI for those companies. Now, if you're a company like NVIDIA, you're listening to the Microsoft and Google conference calls and going, yes, and like, buy more of our chips, because that's what you keep saying.
Listen, Tesla is doing it. Like, I think every H100 chip that NVIDIA can make will be sold.
For sure.
There's no doubt.
And this opens the sort of competitive landscape. Like, is there somebody who can come in and dethrone NVIDIA? Is there somebody who can come in and create a product that's similar and cheaper?
I think we talked about this in previous podcasts. That's the beauty of capitalism, right?
Yeah.
If you have a lot of margins, if you have a lot of profits, some other player is going to come in and is going to try to take some of those profits away from you.
For sure.
That's what we want. We want that democratization.
Correct. Right? It's generally a smaller company that comes in and kind of, dethrones them. And to go back to your point, like, America's innovation, like, this is what Warren Buffett always says, right? Like, never bet against America, right? America has problems. We all kind of feel a little bit worse, I think, this in the last few years, regardless of what side of the political spectrum you're on, we all feel a little bit worse. But remember, like, don't ever bet against this country, the innovation that happens in this country.
Even I will take it further into California. If you look at my Twitter, I've been kind of pissed off at what's going on politically in California. We're doing some really stupid bets. A lot of people are leaving. We're seeing our clients kind of suffering, and it sucks because I love California. It's my home. Blah blah blah. But I looked at the top 30 AI companies. 27 of them are in California. 27.
What were the 3 that weren't? Now I'm just curious. Like,
it was in New York, I think. Anthropic is in California, actually, but there's just a couple in New York, one in Europe. Again,
there's a European one.
There's a European. There is.
And it also brings me to this point, like, right? So when you talk about investing, it was like, oh, you should have a certain amount in international. You should have a certain amount in this, and frankly, like, the rest of the world, other than maybe, like, there's some stuff in Asia, obviously, between China, Japan, Korea, but, like, Europe's lack of just innovation, like, lack of investment in innovation is really why the U.S. stock market has dominated the international stock market.
That's a much bigger conversation, but I think it's also the structural of how things work, right? Where you don't get compensated for the risks that you take.
Absolutely.
That's really a problem, or at least detrimental to innovation, right?
People ask me that all the time, and like, oh, why don't you have more exposure to these countries or this area? I go, name a European tech company.
Yeah. I mean, there's not that many.
That's the point, right? It's the next revolution, right? So, ASML is a company that at least helps make chips, so they kind of have a tech adjacent. Yeah. But it's very hard to compete in the fourth industrial revolution in market gains if you're not competing.
Yeah, and also a lot of European players are in America and vice versa.
Sure.
So you have that kind of cross-border,
global markets, ultimately versus where the country is. But
so let's bring it back to this bull market. So we started a bull market.
Well, tell everybody where these actual terms come from, because I honestly had no idea until a couple of years ago. Like, there's a lot of theories as to where these sort of names come from.
So this is brought to you by Bard from Google. What is a bear market? The theory suggests that the term originated in the 17th century when traders in the London Stock Exchange will sell bearskins that they did not yet own. betting that the price of bearskins would fall before they had to deliver them. These traders were called bearskin jobbers, and the term bear became associated with the market as declining in value.
Okay.
Go figure.
And bull?
Bearskin jobbers, baby.
Yeah.
Let's go.
And bull, something about bullfighting or something like that,
so
right?
the bull theory is just that term in the 12th century. Like we're going way, way back. And bull baiting was a popular blood sport. Bull baiting, a bull would be tied to a stake in dogs and will be set upon it. The bull will typically charge at the dogs, and its horns will be thrust up into the air. This aggressive behavior came to be associated with the market that was rising in value, and the term bull was used to describe such market.
All right, I have multiple issues with this one.
Yeah.
First, obviously, we do not condone
bull
baiting with your dogs. Please don't do that. That's horrifying. Two is, did they even have real markets in the 12th century? I mean, modern banking didn't even come to be until the Medicis in the 14th century, I believe, 15th century. So I don't even know that. I always just assume that a bull market is called a bull market because a bull charges, right? It's aggressive.
Yep.
And a bear market, like bears hibernate. That's what I always thought. So like the market's kind of going into hibernation.
That's a good one, yeah.
That was my old thought. I don't know. Honestly, we don't know if any of these stories are actually true or not. The bearskin one sounds a little more, normal than the bull one.
Yeah, it is. Here you go. I think we'll take Bard's answer here as probably right, maybe 70-80%.
I think ultimately, if you read those, and I read a few of these, like none of them really know. Like this is sort of the guesses that people have as to how this happened. But I think they're great stories nonetheless.
Yeah. Well. Now we know what a bear is. We know what a bull is. Perfect. And we are in a bull market. Yeah. So let's talk about that. I think valuations, as you said, as you rightly pointed out, are definitely high, right? 7-8 companies this year have basically
the Magnificent Seven.
Yes, exactly. Have driven basically 85% of the return of the markets, right?
Up until the end of last quarter, actually over the last month and a half, 2 months, we've definitely seen a broadening out of the rally, which is generally a good sign, which is generally a sign that the rally is sustainable. Yeah,
and that's a very good point, right? Leadership is not always bad. Like when you have concentration, and then that concentration goes towards the rest of the economy or the market, that's a very good thing, and we're starting to see that. Okay? That's what makes me more optimistic about the future. I agree. Right? So maybe don't go out and try to buy Apple and Microsoft and Google tomorrow, but there's a lot of other great companies that are going to benefit from this. You still don't want to be the guy that's going to speculate. You still don't want to be the guy that's going after the meme stocks, right?
Yeah. Or please don't buy meme stocks.
Yeah. No, in general, don't, right? Yeah. But the broadening of this means that, other sectors, smaller companies, mid-sized companies, even international companies will start benefiting from this. It just means money is going towards other places in the economy. Yeah.
Which it should, right? These companies should not, even the NASDAQ's done, I think its third major rebalance in history. The NASDAQ came out and said, look, these companies like Microsoft and Apple are just too big in an index weighting. I think the top 5 companies represented 70% of the index or something like that. Top 7 companies. So the Microsoft and Apple specifically, because their market caps are $3 trillion and $275 respectively.
Yeah. That's a lot of money, man.
That's so much. So
did you tell me this? I think it's bigger. Microsoft is bigger than all of Italy.
They said they were showing Apple, but basically, Apple is bigger.
No
than
offense
the GDP
to all my Italian friends, but that's a lot.
That's a lot. The Italian GDP is less than Apple's market cap.
Yeah, that's amazing.
So these companies had to be trimmed back down just because it's just
let's for the purpose of just education, what does NASDAQ rebalance mean?
So if I bought the NASDAQ, let's say the NASDAQ 100 is one of the popular ETFs that people use, between Microsoft and Apple, those two companies represented 30% of the overall weighting of the index. So it's what's called market cap weighted, right? The bigger your company, as far as stock market is concerned, the more weighting it has in this index.
Right.
A lot of the big indices are market weighted. Not all of them, but a lot of them are market weighted. So you have a company like Apple, and let's say Apple and Microsoft have done so well this year, they're dragging the overall return of the NASDAQ so aggressively that they're moving these markets too much. And even in the S&P 500, these companies now together make up almost 15% of a 500 company index. Right, so the top 10 make up like 80% of the overall value of the S&P 500.
Yeah, so you can't have a 500 company index with 10 companies being 80%. Right.
At the end of June, basically the discrepancy between the S&P 500, for example, and what we call the equal weighted S&P, where like every stock is equally weighted versus market cap weighted, the discrepancy was like 15%.
Yeah, it's a lot.
Yeah. So we know that the big companies are really dragging. So now we're seeing a little bit of a reversal in that. Not a huge
And that's
one.
where the opportunity is.
Correct.
Right?
Absolutely.
I mean, that's the opportunity is like, hey, there is an additional 490 companies that you should look at.
Correct.
Right? And also, that doesn't mean that every company is going to be huge. I think that's the other thing. And I think there is a bit of hopefully skill in trying to figure out, what is the next NVIDIA or there's the next, Apple, and there's always going to be a next Netflix, right? And that's kind of what we try to do here in our investment management side of the business. But the reality is you don't know for sure who that's going to be.
Correct. Yeah. Exactly. So but it is, you sell some high flyers sometimes, and you buy some stuff that hasn't done as well. Much the same that a lot of what we were doing last year, right, was dollar cost averaging, buying into some of these tech names that were getting hammered last year.
Yeah, and to put that in perspective, right? Last year the NASDAQ was down 40%. 37%,
35%. And for math, I know sometimes it's hard for people to understand this. For the NASDAQ, if it goes down 35% or 30, it has to go up basically 50% to get back to where it was.
Correct.
Without getting into how fractions work and all that, just kind of know that like the number, if you go down 35% and up 35%, it doesn't mean you're back to even.
Yeah. And if you just close your eyes and did not see what 2022 was about, you're basically almost back to even.
You're close, right? Depending on whether you were more heavily aggressively invested or if you owned like the meme stocks, or if you owned like really overvalued nonsensical tech like Virgin Galactic, for example, you're nowhere near, right? I think ARK Investments is still like 50% off its high.
Yeah, there's a lot of companies are still 80-90% off there. They should have never been either publicly traded or never had the value.
Right. But our thesis all last year was like, look, dollar cost average and buy if you are buying individual equities, right, buy the ones that have the best potential, buy the ones that are safer and have good balance sheets and are in the markets you want to be in. We didn't know if it would be this year or next year, but eventually these companies will come back.
Yeah. So now we are in the bull market, which actually, by the way, I'm watching the Yellowstone, the show. A lot of bull baiting. I highly suggest the show is pretty awesome.
Okay.
Yeah.
All right.
But a lot of bulls in that show. I digress.
That's a plug for Yellowstone here. Hatem is not being compensated by Hulu? Who is it? I don't know where
it's Peacock.
Oh, God.
Yeah, God.
You actually have that?
I do.
How many streamers do you, like, it's just like, there's too many. I can't anymore.
I am our streaming expert in the office. I have to have everyone.
You have to have, you are the streaming expert?
Yeah.
Okay.
Peacock has a lot of golf, which I like to watch sometimes.
The only thing I want on Peacock is reruns of The Office.
Yeah, they have Premier League, bro. It's
That's true, but so does Apple TV.
Not Apple TV. Apple TV has MLS.
MLS, my bad.
Yeah,
sorry.
So if you like sports,
I know that was blaspheming. I'm sorry. I apologize.
It's blasphemy.
Did
literally.
you see that? The first game with Messi? What a great.
That was the last game. Second game was yesterday.
No. But the one where he like actually like
He
scored the goal.
Scored
like
2 goals yesterday in 20 minutes. Again.
That's great. And let's be honest, Messi's gonna probably score a lot in the MLS.
Yeah.
But just a perfect ending to the first game that he played.
It was a Hollywood ending.
Beautiful.
It was a Hollywood ending. That's for sure.
And it was nice too.
It was amazing. I mean, his just another level.
It's like they scripted it, like you said, exactly.
Yeah.
So we're in a bull market.
Yeah. So we're in a bull market, and I think people get ahead of themselves, like, okay, well, things are too expensive. Where do we go from here, right?
Yeah.
As we talked about, we're optimistic because the broadening, but ultimately, if you look at history, and if history is any judge, bull markets last between 3 to 4 years, maybe 5 years on average.
Yeah.
Right?
Yeah, it's about 4 to 5 years. And again, we have very extremes, and this is why I like to use the median versus the average. But, the median return is something like 130, 140% over that time period. The last bull market we had, which was the one that ended in 2020.
Yeah.
So started in 2009, right after the financial crisis.
That's a very long secular bull market.
That was the bull market that lasted 11 years.
Yeah.
Like that's one of the longest in history.
Yeah.
And then we had the one in the 90s. Both of those returned over 400% during those times.
And that doesn't mean that we don't have pullbacks, by the way. For sure. Right? Like, I think that's really what's important is no market goes straight up.
Correct.
So.
Everybody, it's funny. I have this conversation with clients all the time. I go, oh, do you remember, the clients who I've had for a long time? I go, other than COVID and last year, do you remember any of the other either bull or they weren't quite bear markets, but there were literally 2 times where the market went down 19.9%. So it wasn't a technical bear market, but this is this is the psychology, like people sitting there at that 20% mark going, okay,
I want to buy,
I'm buying right here.
Yeah.
And then it kind of like pushes it right back up. But with that said, do you remember what happened in 2014? Do you remember what happened in 2015? Do you remember what happened in 2018?
Yeah.
Hardly any of them actually remember it.
Yeah. I mean, I do remember because I was...
You do, and I do, because we are investors for a living, and we actually have to talk to clients when this stuff is happening. Yeah. But they don't even remember it.
Yeah, no, 100%.
Right.
But I think, let's talk about... Because the question here would be, well, why not wait for the next bear market and then invest then? I think, and the question here will be, first of all, do you know when the bear market is going to happen?
I mean, you and I have been in this business for a while. I started in 2009, so it was right at the bottom of the bear market.
I started before.
You started before
2006,
right? My point is that basically for a large portion of my career, everyone was waiting for the next bear market, and there were many people that I spoke to that said, okay, but the next time the market goes down big, I'm going to buy it.
Yep.
There's multiple flaws with this strategy.
Yep.
One is you have no idea. It could be a year, it could be 10, as we saw.
Yep.
And 2 is when that time does come, they're never comfortable investing that money anyway. Because they're like, oh, I'm going to wait for it's 20, it's 30. I don't know. The market looks like it's falling apart. Maybe it's going to go down 100%. And you go...
isn't someone said there was more money lost waiting for the next up move than actually money lost, market's going down?
It's my favorite quote in investing. More money has been lost waiting for the bear market than has been lost in all the bear markets combined.
See? So that's one thing that you have to think about.
Yes.
But also, too, is, oftentimes some of the best returns in the market happen during tougher times.
Absolutely.
Right? When I think, and this is kind of this year, I think we probably reached max pessimism. Right? You know what I mean?
For sure. At the end of last year, for sure.
And also had some of the best days this year. I think I remember 1 week we're up 7 or 8% on the S&P.
Yeah.
Right? Which was a really, we got Fed raising rates, banks falling. It was a lot of really shitty news. Yet the market seemed to kind of put that in the back, as you said, and just climb the wall of worries, right?
Yeah, because again, the market's looking forward. The bank stuff, the market read through. There were a few days in March, right, where the market got hammered. as the fears of contagion and banks spread. But then they realized, well, it was only a couple banks that were really exposed, and Jamie Dimon will buy out your bank and make a huge profit if you need to.
Dude, I have to say this. So JP Morgan announced their earnings last week, and they made $2.7 billion last quarter on the First Republic transaction. Just the fact they bought the First Republic, basically they figured out how to put FDIC with a $10 billion loss while they took out a $2.7 billion profit. Guys,
Capitalism.
Genius or whatever.
Kind of BS. I mean, listen, he's playing, if the rules are set in his favor, whatever. It sucks. It's stupid. I agree.
Yeah.
But the taxpayers have to pay for it ultimately.
We digress.
Yeah.
Jamie for president.
Yeah. I lost my train of thought. I don't know what they're
So now
about.
talking about the best days happen during the worst time.
Oh, yeah,
So I think for clients or people who want to invest, trying to get out and trying to kind of time the best times, that's when to invest, just doesn't work out.
Yeah, look, if you saw the movie The Big Short, right, the whole movie's or read the book, the whole movie and book are centered around this short bet against the housing market. There's one of those investors who will remain nameless, who made
Are you afraid to say names?
No, I don't care. I honestly don't care. The guy is nobody, but has been calling for the worst corrections in every year basically for the last 15 years. And the dude has literally not made a right call in 15 years, but because he got The Big Short right, he fashions himself some kind of market genius. But all the bad calls he's made since then, I don't even know if he's up, honestly.
Yeah, man. It's,
since The Big Short. So
even a broken clock is
right,
right?
But look, the market goes up 3 out of 4 years, and markets are so much about psychology. No matter how many times no matter how many stats you give people, or how many times history repeats itself, when you're losing quote unquote money, or your account value is going down, it's very hard for people to just put that feeling aside and go, okay, I know this is the time to do it.
Right.
Because our brains are hardwired to avoid, right? They're hardwired for fight or flight mode, for panic, for evolutionary, save yourself kind of thing. Right? It's not. It works against us in a modern era when we're doing things like this, right? So we constantly try to tell our clients this. I joke with my clients. I go, listen, the worse I feel when I'm buying something, the better of a buy I know it is.
Yep.
So just keep that in mind. Don't put all your eggs in one basket. We learned that obviously last year,
right? But
keep investing over time. Dollar cost average in over time. There's this chart that I love to show my clients.
Yeah.
And it's only updated, I think, till 2021, so I don't have the numbers through the last correction. But it basically shows that if you miss, if you basically invested at the top of the market in 2000, and you basically you put your 10 grand in or whatever, and you went to sleep like Rip Van Winkle, and you woke up 30 years later.
Rip Van Winkle.
That's the throwback right there.
Totally.
You're talking about 11th century or 12th century bull baiting, so I'm going up to Rip Van Winkle for the American Industrial Revolution. That you woke up, and in spite all of the insane market downturns that happened, 2000 through 2002, the financial crisis, and COVID, you basically 5x'd your money during that time.
Yep.
But if you missed just 10 trading days, you basically cut that in less than half.
Yep.
And if you miss 20 and 30, if you miss 30 trading days,
this is 20 days in fucking 20 years.
Yeah. And you literally missed, if you missed 30 of the best trading days, you actually lost money over 30 years.
Yeah. So we'll put that chart up, and obviously you can email us. We'll send it to you. But it's very powerful. It's really kind of trying, as Ayal says, strip the emotions out of it, and let us help you kind of make sense of it,
Yeah.
So where do we go from here?
Let me get my crystal ball. Hang on. It's in Ross's office.
Ross is out. He's on vacation, so the crystal ball doesn't work.
But look, we can only use historical data. We can only use statistics, obviously, is what we know.
Yep.
If history is a guide, generally when we have a up market for the first half of the year, nicely up market, and this is only like the 14th best start to the year, you know what I mean? So it's not like we're having some like insane market, but generally speaking, the latter half of the year bodes well, and it bodes well for, again, a multi-year growth segment.
Yeah. It's really rare that we don't have a positive finish with things like this, but I think it's more so about the fact that we generally have better signs in the economy, right?
Yeah.
We're definitely seeing that the bottom is not falling apart. We're seeing that this banking crisis is not getting out of control. We're seeing that unemployment is not going out of control, right? So I think all those things are positive, and I think that the markets will reflect that.
Yeah, but that being said, it doesn't mean that we can't get a bad inflation report and the market go down, next week or whatever, or the Fed decides that they're going to raise 3 more times.
Yeah, and that's really the boogeyman, right? Like, is inflation really under control? I talked to one of my someone who works in the cheese business yesterday, and he said cheese prices. Well, CEO of one of the biggest cheese company actually.
Like, people that like cut cheese.
Yeah,
like,
no, he was. He's actually pretty big deal cheese person, and
he's the big cheese, if you will.
He's literally the big cheese. I hope he listens to this. He's literally the big cheese, and he was telling me prices are down huge, and you can see this across the board, right? We're seeing it, even us shopping, things are coming down.
I think the big one that they're still concerned about is this quote core inflation, right? This housing costs. Although we hope it's coming down, we have some new supply of multi-residential
home builders have been doing really well for us this year.
Yeah, for sure. I mean, there's so few homes now that but really, like, there's areas of the market that still, inflation is still fairly high. Healthcare costs are not, like the things that are quote stickier are still higher than we want them to be.
Right.
But again, it's all about the trend. It's all about the move. That being said, the easiest comparison year over year on inflation, we've already had it. So now inflation becomes even a little bit trickier. So it remains to be seen where we go. But ultimately, look, if we're not having, we sort of redefined the word recession like 4 times, over the last like 12 to 24 months. We technically had one at the beginning of 2021, but it was because of a trade deficit. We technically had an earnings recession. We technically but we haven't had a true recession, which is normally just marked by large increases in unemployment and drops in consumer spending. I think that's the sort of core idea of what inflation
and this may happen the next 6 months or so. And it doesn't have to be a bad one.
Yeah.
It doesn't have to be one where we're worried about losing our homes or, or the banking system falling apart or,
Right.
It could be like a little mild one, and we'll move on and things will come back.
But here's the other thing. And it gives some credence to this multi-year bull run. There's still over $5 trillion sitting in cash. Yeah. And over the last 3 times that markets have peaked at their cash levels, the rally has ensued.
Right.
Because people are sitting now, like things are not as bad as people thought. It is a hallmark of a recovery investment market when everybody is so pissed off about it. Everybody's upset that they missed out, and so you have all this money on the sideline, earning 5%, 4%, whatever they're earning. If they're earning anything, because a lot of people still have their money in checking accounts.
You feel good about your money market earning 4% until you see your S&P at up 20%.
Correct. Exactly. And it's a fulfilling prophecy if everybody thinks things are getting better. Last year was kind of the opposite. Everybody thought things were getting worse, and they got worse, and now people think things are getting better, and they've gotten slightly better.
Right.
So that much cash on the sideline has to go somewhere.
Right.
And generally that's stocks, but it could also be, one of the things we haven't talked about is, bonds have been such a terrible investment over the last decade. Like, we can now actually buy bonds, and not just money market short-term bonds, but core bonds that are good things that we can have a rally in bonds if the Fed starts to decrease rates.
Go down, bonds do well. Yeah.
Bonds really do well, and that's another thing that people don't talk about is if you're in a lot of our clients, they're not 100% stock invested. I mean, the vast majority are not even close to 100% stock. But if you buy, a balanced portfolio today between stocks and bonds, you have a good, there's a better chance of making, high returns with less risk now because
Right.
the bonds are going to earn you 5-6% hopefully. So that's something.
There is opportunities and options, which is more than we expected or we looked at 6 months ago, 12 months ago, right?
Yeah.
So I think really that's where we are. And this cash story is story that's not being told.
Yeah.
I know Gerber Kawasaki bought hundreds of millions of treasuries the last 12 months, you know, for clients because we wanted to be safe, because we could get 5% and so forth. That money is going to come due the next 12 months and it's going to go into other things, right? And this is across the economy. This is not just us, right? So I think that story is going to play itself out next couple of years.
Yeah. So, you know, don't ask us where the market's going in the next 3 months. We don't know. I tell every single client.
Yeah.
But you know, we're cautiously optimistic over the next, you know, multi-year.
Yeah. So we talked about this secular bull that's driven by a truly kind of transformative technology, which is AI and innovation that comes with it, right? The fact that things are not as bad as people expected.
Yeah,
you know,
for sure.
We have a lot of cash. The broadening of this kind of growth story, so other players are starting to benefit from this. You know, and the fact that really, frankly, things are not as bad as people expected.
I mean, you tell me if this scenario sounds like a recession. So and so pays $10,000 for Taylor Swift tickets. Every hotel,
if they can get one,
if they can get one. If every hotel in any city I look in is booked up, you know, months in advance. Like, this is not a recessionary idea, and I get that, you know, things might be slowing down a little bit. They can't increase at the breakneck speed that they were. But even if we have a recession, it probably will be mild. But a lot of, you know, the sentiment around whether we are having a recession is actually, you know, increased dramatically.
And again, I think I want to reiterate, even if we have a recession, it doesn't have to be a bad one. You know? And obviously we say this with us very cognizant with the problems in the real estate market, the problem in the commercial side of the real estate market. The issues are, you know, with the entertainment business and some of the streaming losses and all that stuff. So there is pockets that does look pretty grim. It does look bad.
For sure. But I think that's the case always, right? There's always the case for certain things are, you know, the writer strike and SAG and all that. Hopefully, you know, that's obviously going to be temporary. The question is how long. Obviously those people are hurting.
I mean, we're starting to see it. Obviously we have a big allocation to clients in that space. And you know, people are generally worried. People are starting to stop putting money away. People are starting to take money out, you know. So it's really impacting a lot of families and people, especially in LA. And we hope it's kind of resolved, but you know, the demands are so far apart. I don't know where things are going to go. So
that one's unfortunate in a different way.
Correct.
You know, the streamers, the studios, they're looking to cut costs. Honestly. And you know, I think it's unfortunately just a waiting game for them. But you know, commercial real estate, like, this was something we knew, you know, for years was coming, even before COVID, and obviously COVID put the nail on the coffin.
I mean, I thought some of the people that I talked to in commercial real estate last week told me that a 60 to 75% price decline in commercial real estate is probably what needs to happen.
That's crazy. That's crazy.
So if you think, and especially like in places like Los Angeles, downtown LA.
When you say commercial, but you mean more specifically office. Office.
Like Class A buildings are probably a little bit more insulated, but you know, Class B and below, even Class B plus, between 60 and 75% price reduction needs to happen.
I mean, how many tenants do you see in our building?
Nothing.
It's like us.
It's like us, right?
That's pretty much it. Those are definitely tough. But you know, there's always going to be sectors, and that's another like argument that some people have made, is that maybe we've had a rolling recession, right? We had it in tech,
different areas.
Right? We had it in tech last year, as we saw, you know, major job cuts a little more this year. You know, commercial real estate. You know, home builders, I feel like had it for like a week. You know, so there's this sort of rolling. It's not unlike what happened in 2021 in the markets. We had these sort of rolling sell-offs in markets. And, you know, the definition can constantly change, and markets adapt to the information that we have. So, you know, I do want to invest in generative AI, but I definitely don't want to invest in commercial real estate.
Yep.
You know, or at least office space real estate.
And those are the decisions we can make, right?
Yeah.
That's kind of why we exist and why we want to basically try to allocate to the right places.
Yeah.
So we'll leave that on a positive note. You know, we're gonna go bait some bulls.
We're not gonna bait. We're not gonna use any dogs. So I'd like to make that clear.
We're very family friendly here and animal friendly. So
but no, again, you know, to leave it with something positive, as you said, right? Like, hopefully, you know, you're investing over time. You know, the short-term gyrations of the market is something I tell people all the time. The thing that makes the market the safest thing is the people that are so afraid of it. Right? You put your money in a private investment and it doesn't move, and you somehow feel good about it, but then they tell you that you can't get your money out for 10 years. Right? That's not better. The stock market is liquid, and because it's liquid, because it's the most liquid investment out there, it creates volatility. But volatility and risk are not exactly the same thing.
They're close, but not the same.
They're not exactly the same, right? Because if the S&P goes down, what's the chance that the S&P goes down 100%? We can't say zero, right? We can't say zero,
close to zero.
Close to zero, right? So that's what I tell people. And people will literally ask me these questions during, you know, like sometimes when markets are down. What if I lose all my money? And I go, listen, you're invested in a broadly diversified portfolio. The chances are not that. So invest for the long term. Keep your eye on the long term game.
Stay diversified.
Talk to us.
Don't think it's late. You know, I think that's the one thing.
Correct.
We say this all the time too. It's time in the market, not time in it, right? It's time in the market.
Exactly.
You know, so it's you know, Microsoft is down 5% today. I don't know why we're selling Microsoft because of the numbers, you know, but it's kind of these opportunities like this. So.
For sure. So keep on keeping on.
Yep. We're here for you. Go enjoy your summer. Let's hope this bull is a long one. All right. Cheers.